Hello, this is Ed from SOS Bookkeeping. Today we're going to go over the basically the P&L and the balance sheet for HOA accounting. And there's lots of other reports as well, but these are the two we're going to focus on, the primary ones. So as in for business, the profit and loss statement is it covers a period of time, usually a month, not always. You can see a sample here on the screen. This is an actual HOA of their financials from month ending in April. And so, as you can see, it has the current month and then the current month compared to the budget for a month, has the year to date with the budget for compared to the budget for year to date, and then the annual budget. So we have 5 columns here. Generally accepted accounting practices says that we should use accrual accounting for this. This particular HOA uses a modified or hybrid. Some call it accrual for the income and actual for expenses. The P&L report for an HOA is intended for the operating expenses only. There's a supplemental report that could be used to cover the reserve accounts. So let's break this down a little bit and see what we have here. So we have the income side of things, which would include assessment income, special assessment income if there is any. And as you see, there's a number here. So there is a special assessment that's been announced. Interest assessments on late payments, late fee income, interest reserve income. So this does not belong here. But let me preface this by saying there'll be some things on these reports that are unusual, but they're dictated by the property manager for this particular HOA. So that's what's going on. And then any legal fees assessed. So these are your basic income sources for an HOA. Not very complicated, straightforward. Then we have the expense. So again, this is a cash basis. If this were accrual basis, then you'd also want to have a supplemental report, the cash disbursements ledger, but which would show you the actual cash disbursement. But this serves that purpose since it's a cash basis and not accrual basis. And nothing unusual here. You can see the typical operating expenses for an HOA with a total expense here, and then a net ordinary income of $3,642. Now, these numbers will transfer to the balance sheet. And for instance, if not all of the assessment income has been received, that would be reflected in an accounts receivable, which would offset this income on the balance sheet. Now, down here would be your other income and expense. And because they've included the reserve income in this report up here, you can see this number, the $4.01. It's got to be taken out over here. And the reason they do this is because they do not produce a reserve fund summary. So it's put on this to show what the figure is. So that is pretty straightforward. Here's the number for the month. And this is what they anticipate for the budget, because as you can see, let's take a look here. You can see the budget. Let's go up here. So this is the budget for the period, for the month. Requires a transfer to reserves of $6,049.99, which was not done. And you see it's only the $4.01, which is the interest, which really wasn't a transfer because it never came to the operating account to begin with. It went straight into the reserve account. So that's what makes this a little bit confusing in this area. You can see the annual budget here. The total amount allocated for reserves is $72,600. This is another unusual arrangement here, that the reserving allocation includes the interest. Typically, that would not be the case. Anyway, so that's how that works. And here is the net income number for the year to date, $60,877.69. We'll need that number again in a minute. So that covers the income statement. Pretty straightforward, even for an HOA. Where a little bit of difference comes in is in the balance sheet. So obviously the structure of the balance sheet is a snapshot in time. And the structure is similar, assets, liabilities, and equity, or owner's equity. And the formula is to take your assets minus liabilities equals owner's equity. So let's see how that's all laid together. So in the balance sheet, we have the first section here, which is your current assets. And anything that's labeled current in a statement is something that is less than 12 months. So whether it's a receivable or a payable, if it's less than 12 months, then it's considered current. So these are the balances in the operating accounts. These would be checking accounts here, checking savings, but these are checking with a total for operating. And then the reserves. These would be a savings, there's a CD, and then another savings for a total of $98,349 for both the operating checking accounts and the reserve savings account. So then moving down here for additional assets, we have accounts receivable. So accounts receivable here is the offsetting number, the 4,907. So that's the amount of assessment that is remaining uncollected at this point. This should be supported by a supplemental report, an aged accounts receivable, and an aged account receivable report would show up with the outstanding receivables in columns of less than 30 days, 30 to 60, 60 to 90, greater than 90. So you can see the aging of those receivables. Some HOAs will call it a customer summary, and some have that aging in it and some don't. But the aging is very useful to have. And then special assessment. This, as I mentioned earlier, you can see there was a special assessment from the P&L for this HOA, and there's $13,000 still outstanding on that. So for a total of $17,907 of accounts receivable. And then other current assets. This is a little bit unique. The exchange account. This particular HOA is part of a larger POA. And so like a homeowner would in an HOA, they'd file an ARC report when they're doing something. This HOA has to file an ARC form, not a report, an ARC form with the overarching POA and accompany it with a deposit. So that's what this is. This is a deposit for a roof replacement. So it's an asset. And then due from operating to reserve. So what this is money that is still remaining in the operating checking accounts, but according to the budget, should have been transferred to the reserve accounts. And you'll see an offsetting account to account for this in a moment. So that's an asset as well. Giving the total current assets of $137,774. So all right, so let's then move that. That gives us the total picture for assets. Let's move into liabilities, and again, current liabilities. So here's your prepaid assessments, and what this would be is some people might pay annually, quarterly, and so on and so forth. So they've paid, but and we've received the money. The money's been received by the HOA, but it hasn't been earned by the HOA yet. So these would be considered prepaid assessments. That's why they're a liability, because that hasn't been earned yet. And then here's the contra account basically for the due to from reserve. This is due to reserve from operating. So it's the due from operating to reserve, due to reserve from operating. And it's the same amount, the 17,394. So for a total current liabilities of $35,960. And then there are no long-term liabilities, no loans. So that's also the total liability. So then we'll get into the equity section. And in the equity section, we have the reserve accounts. And you can see there's some negatives here. Because keep in mind, these are not the actual cash accounts. These are the bookkeeping accounts. So this has come out of the lump sum accounts of the reserves here for these allocations. So you can see some are in deficits and some are in excess. And there would be a reserve budget created at the beginning of the year that would determine the needs looking forward, how much money would be required for each of these. And these are greater than 12 months. So they would not be, that's why they're not in operating, they're moved over here to reserve, because these might be every 20 years or every 30 years. So that's why they're in the reserving. So this is the total for the reserve accounts. And then the prior year funding, let's take a closer look at that. Typically that would be called prior year equity. And it's the accumulated deficit or surplus, in this case surplus, since inception of the HOA. And there's in accounting, of course, we're talking about bookkeeping, but a useful tip here is that accounting uses a lot of ratios. So here you should have a ratio of about 10-20% of your annual assessment. So you'd be looking for, this assessment is 29,700 is the annual assessment. So you'd be looking for ideally a number here of about 29. Oh, I'm sorry, I'm mistaken. We're looking at the annual number. So the annual number is 356,000. So you ideally would have a number here of 35,600 up to 71,200 would be ideally in this number. And you could see that's why they needed to do a special assessment, because this was not falling way behind. Net income, this is for year to date, that's 60,877, and we find that number right here, 60,877. So that's where that comes in, and giving us a total equity of 101,853, and total liabilities and equity equal 137,814, which should equal 137,814. So we are in balance, and the equity for the association is this $101,000. Now, each of these items here on the balance sheet should have a supplemental report showing where they came from. So you would have some of them that I mentioned already, the reserve fund summary, which is almost like a P&L, but for the reserve account, showing what the beginning balance was, what came in, what was used, and what the current balance is. Your aged AR, which would be your aged accounts receivable for your customer summary of who's behind and by how long and how much. Your prepaid assessments would give you an idea of who's prepaying, but the bottom line number is what's important, and that's from that report you would get this number. And same on your aged AR, that number would be reflected here. Cash disbursements ledger, if you're doing a cash expenses like you are in this one, you don't really need that. General ledger is a record of every transaction for the period. And that just helps to tie it all together. When you're looking at these reports, you might have a question about a certain thing. Some of these might reflect, let's see, for instance, plumbing or sprinklers and irrigation. Some of these others may be a couple payments for something. So you would not see that on the P&L. You'd have to go to the general ledger to see those separate reports. And then you'd want to see a bank reconciliation report, which is just like what it sounds: the beginning bank balance, in, out, and the bank balance. Make sure it balances both with your balances on your balance sheet, which might not be the case in every circumstance. I won't get into that at the moment. But it was certainly balanced with your bank account. So that's the general overview of how the balance sheet and income statement work for an HOA.